I need you to do something for me. Go to your banking app, look at your credit card interest rate. Whatever country you're in, just check the number. In the United States, the average credit card APR is around 24%. High, sure. In Europe, it's typically between 15% and 20%. In Japan, credit card rates are capped at 15% by law. Now, let me show you Brazil. The average credit card interest rate in Brazil is over 400% per year. Some cards charge over 800%. And the special revolving credit rate, what you pay if you don't pay your full balance, averages 432% annually. Let me translate that into human terms. If you put $1,000 on a Brazilian credit card and only make minimum payments, after 1 year you owe over $5,000. After 2 years, over $25,000. That's not a typo. That's how the math works when interest compounds at these rates. Brazil isn't a poor country. It's the 9th largest economy in the world. It has sophisticated banks, a modern financial system, and more fintech startups than most of Europe. So why do Brazilians pay interest rates that would be illegal in virtually every developed nation? The answer isn't incompetence, it's design. This is the story of the debt prison, the most sophisticated wealth extraction system in the Western Hemisphere. A machine that transfers billions from the poor and middle class to a handful of banks year after year while everyone pretends it's normal. This is why Brazil can never get ahead. 1. The spread, where the money goes. Let's start with a number that explains everything. The spread. In banking, the spread is the difference between what a bank pays to borrow money and what it charges to lend money. It's how banks make profit. Every country has a spread. Brazil's spread is the highest in the world. The Central Bank of Brazil, Selic, sets the base interest rate. As of recent years, it's fluctuated between 10% and 14%. That's what banks pay to access money. When banks lend that money to consumers, they charge 300%, 400%, sometimes 800%. The difference, that spread, goes directly to bank profits. Brazilian banks are among the most profitable in the world. Itaú, Bradesco, Santander Brazil, Banco do Brasil, these institutions print money while their customers drown. How much profit? Brazilian banks consistently report returns on equity above 20%, in some years above 25%. For comparison, American banks consider 15% excellent. European banks celebrate 10%. Brazilian banks aren't just profitable, they're extraction machines operating in plain sight. And here's the dark part. They've convinced everyone it has to be this way. 2. The excuses. Why they say it's necessary. Ask a Brazilian banker why interest rates are so high, and you'll get a well-rehearsed list of explanations. Default rates are high, true. About 30% of Brazilian borrowers are behind on some debt, but here's the circular logic. Default rates are high partly because interest rates are high. When you charge 400% interest, more people fail to pay. The banks use the crisis they created to justify the rates that created it. The legal system makes recovery difficult. True. Collecting on bad debt in Brazil is slow and expensive, but banks have priced this in for decades. At some point, recovery is hard becomes, and therefore will charge infinity. Brazil has high base rates. True, the Selic rate is high by global standards because of inflation history, but the Selic is 13%, not 300%. The gap between the base rate and consumer rates is the spread, and that spread is a policy choice, not an economic necessity. Operating costs are high. True, Brazilian banks have extensive branch networks and high labor costs. But digital banking has been growing for a decade. Costs have fallen, rates haven't. Every excuse has a grain of truth, but grains of truth don't explain 400% interest rates. What explains those rates is something simpler, because they can. 3. The oligopoly, 5 banks rule everything. Here's the structural secret of Brazilian finance. There is no real competition. 5 banks control approximately 80% of the Brazilian banking market. Itaú Unibanco, Bradesco, Banco do Brasil, Santander Brasil, Caixa Econômica Federal. That's it. That's the whole game. When 5 players control a market, they don't need to collude explicitly. They simply watch each other. If Itaú charges 400% for credit cards and Bradesco charges 395%, that's not competition. That's a choreographed dance. This concentration didn't happen by accident. It happened by design. For decades, Brazilian banking regulations made it nearly impossible for new entrants to compete. licensing was complex, capital requirements were high, the bureaucracy was labyrinthine. Foreign banks that tried to enter either failed or were absorbed. The Big Five built moats around their businesses. They have the branch networks, they have the payment infrastructure, they have the corporate relationships. They have the regulators who used to work for them and will work for them again. When fintechs like Nubank emerged in the 2010 seconds, promising to disrupt this cozy arrangement, something interesting happened. Interest rates on some products fell slightly, but the big banks adapted. They launched their own digital platforms. They used their distribution power to retain customers. They're still making record profits. The oligopoly bends, it doesn't break. 4. The parcelamento trap. How to make debt invisible. Now, let's talk about the cultural technology that makes all of this possible. Parcelamento. Walk into any Brazilian store, look at any price tag. You won't just see a price, you'll see something like R$1.2 U12X DR$100. 12 installments of 100 reais. No interest, the sign claims. Sem juros. This is the parcelamento system. Everything in Brazil can be divided into monthly payments, phones, furniture, groceries, a pair of shoes, a cup of coffee sometimes. The system seems consumer friendly. Can't afford something today? No problem. Divide it into pieces, pay over time, live beyond your immediate means. But here's what's actually happening. When a store offers interest-free installments, they've already built the financing cost into the price. That TV isn't really interest-free. The cash price and the installment price are the same because the cash price has been inflated to cover the installment cost. Consumers who pay cash are subsidizing consumers who pay in installments. The price you see is the debt price. And more insidiously, parcelamento trains Brazilians to think in monthly payments rather than total cost. A consumer in another country might think, this phone costs $1,000. Can I afford $1,000? A Brazilian consumer thinks, this phone costs R$200 per month. I can fit that in my budget. The total cost becomes invisible, the commitment becomes abstract, and people systematically take on more debt than they realize because the system is designed to obscure it. This isn't financial illiteracy, this is financial architecture. The system was built to make debt feel painless until it isn't. 5. The revolving credit death spiral. Here's where the prison door slams shut. A Brazilian consumer gets a credit card. They buy things in parcelas. The monthly payments seem manageable. Then something happens. A job loss, a medical expense, an emergency. They can't pay the full credit card bill, so they pay the minimum. The remaining balance enters something called credito rotativo, revolving credit. This is where the 432% annual interest rate lies. Let's do the math on a typical scenario. Maria has a R$5,000 credit card balance. She loses her job and can only pay the minimum for 6 months. At 432% annual interest, compounding monthly, her balance after 6 months is approximately R$12,000. She finds a new job. She tries to pay it off. But now, she's paying interest on R$12,000 instead of R$5,000. The minimum payment barely covers the monthly interest. The principal never shrinks. Maria is now in the debt prison. She will make payments for years that go almost entirely to interest. The bank will profit, Maria will struggle, and the system will call this a financial product. Over 70 million Brazilians are in some form of debt default. That's more than a third of the adult population. They're not there because they're irresponsible. They're there because the system is designed to put them there. 6. The consignado loophole, guaranteed extraction. The Brazilian financial system has another innovation worth examining, credito consignado. This is a loan where payments are automatically deducted from your paycheck or pension before you ever see the money. The bank takes its cut first. You get what's left. Because the bank faces zero collection risk, consignado rates are lower than credit card rates. They're around 25–40% per year. Still absurdly high by global standards, but much better than 400%. Sounds reasonable, right? A safer loan for the bank means a cheaper loan for the borrower. Here's the dark side. Consignado lending targets the most vulnerable Brazilians, retirees and public sector workers with stable income. Banks and intermediaries aggressively market these loans. Call centers, door-to-door sales, advertisements everywhere. By law, consignado payments can consume up to 35% of a person's paycheck or pension. Many borrowers max this out. Now imagine you're a retiree living on a R$2,000 monthly pension. You take a consignado loan, 35%, $700, goes directly to the bank before you see a centavo. You now live on $1,300. In a city like Sao Paulo, where rent alone can consume that, you're in poverty. But you have a loan, and the bank is getting paid automatically. The consignado system has created a class of Brazilians who are permanently indentured to banks. Their labor, their pensions, their future income, all pledged to financial institutions. They work, the bank takes its cut, and they survive on the remainder. This is legal, this is normal, this is Brazil. 7. Why nobody fixes it. The political economy of usury. Here's the question that should haunt every Brazilian. Why doesn't this ever change? Governments come and go. Left, right, center. Military, democratic, PT, PSDB, whatever Bolsonaro was. Interest rates stay astronomical. The answer is structural power. Brazilian banks are the largest donors to political campaigns. They fund candidates across the spectrum. They employ former politicians and regulators. They own media outlets. They sponsor everything. When a politician proposes interest rate caps, something that exists in most developed countries, the banking lobby mobilizes. It will reduce credit availability. It will hurt the poor who need access to loans. It will destabilize the financial system. These arguments are sophisticated. They're delivered by economists with credentials. They're amplified by a media ecosystem that depends on bank advertising. And they're largely nonsense. Countries with interest rate caps still have functional credit markets. Japan caps rates at 15%. France caps consumer credit at around 20%. These economies haven't collapsed. Credit is available. Banks are profitable, just less obscenely so. But in Brazil, the narrative that high interest rates are necessary has been repeated so often that it's become common sense. Even people drowning in debt will defend the system because they've been told the alternative is worse. This is the final lock on the prison. Ideological capture. When the prisoners defend the guards, the prison doesn't need walls. 8. The fintech hope and its limits. The 2010 seconds brought hope. A wave of fintech companies promised to break the oligopoly. Nubank, founded in 2013, became the largest digital bank in Latin America. They offered credit cards with no annual fees. They simplified account opening. They treated customers like humans instead of marks. Other fintechs followed. PicPay, C6 Bank, Inter. Competition increased. Some fees fell, some products improved. But here's the uncomfortable truth. The fintechs didn't break the debt prison, they just gave it a friendlier interface. Nubank's credit card interest rates are lower than traditional banks, but they're still triple digits. Their personal loan rates are still far above global norms. They're cheaper than the oligopoly, but they're still expensive. Why? Because fintechs operate in the same ecosystem. They face the same default rates, the same collection challenges, the same base rate environment. They can be more efficient, but they can't escape the structural conditions. And crucially, the big banks adapted. They launched their own digital platforms. They improved their apps. They retained their customer bases. The oligopoly got a facelift, but it didn't get disrupted. Nubank is now worth tens of billions of dollars. It's a success story by any measure, but Brazil still has the highest interest rates in the world. The revolution was televised and then absorbed. 9. The human cost. Let's talk about what this system does to people. Financial stress is the leading cause of mental health problems in Brazil. Debt is cited in a significant percentage of divorce cases. Families break apart over money that was extracted by interest rates that would be criminal elsewhere. A generation of Brazilians has grown up believing that debt is normal, that monthly payments are inevitable, that the system is just how things work. They've internalized the prison. Entrepreneurship is strangled. When business loans cost 40%, 50%, 60% per year, only the most profitable ventures can survive. The marginal business, the innovative startup, the small manufacturer, they can't afford the capital to grow. Brazilian productivity stagnates, partly because capital is too expensive to invest. Consumption is distorted. Brazilians spend a huge portion of their income servicing debt rather than improving their lives. Money that could go to education, healthcare, savings instead flows to bank shareholders. And wealth inequality compounds. The rich, who don't need to borrow, accumulate assets. The poor and middle class, who do borrow, pay interest that transfers wealth upward. The financial system is a vacuum cleaner, sucking money from the bottom to the top. This isn't a bug, this is the feature. 10. What would change look like? Is there a way out? Technically, yes. The policies exist. Other countries have implemented them. Interest rate caps. Set maximum rates for consumer credit. Yes, this requires careful calibration. Yes, there are edge cases. But the principle that 400% interest is usury shouldn't be controversial. Positive credit registries. Brazil has moved in this direction with the Cadastro Positivo. When lenders can see full credit histories, they can price risk more accurately. Default rates should fall, which should lower rates. Competition enforcement. Break up the oligopoly. Make it easier for new banks to enter. Prevent the big five from buying every competitor. Actually enforce antitrust law. Financial education. This is the weakest lever, but it matters. Brazilians need to understand total cost, not just monthly payments. Schools should teach the math of compound interest. Central bank policy. The Banco Central do Brasil could prioritize spread reduction as a policy goal. They track it, they could target it. None of this is technically impossible. All of it is politically difficult. Conclusion. The prison we accept. The Brazilian debt prison isn't maintained by locks and bars, it's maintained by acceptance. Acceptance that this is just how things are. Acceptance that interest rates are high because Brazil is Brazil. Acceptance that the banks need to charge what they charge. Acceptance that debt is a personal failure rather than a systemic extraction. Every month, billions of reais flow from working Brazilians to bank shareholders. Every year, the banks report record profits while their customers sink deeper. Every election, politicians promise change and deliver continuity. The system persists because it benefits the powerful, and the powerful control the levers of change. This isn't conspiracy, it's just political economy. Incentives explain everything. But systems can change. Usury was once normal everywhere. Interest rate caps were once radical. The idea that lending should be regulated seemed like socialism until it became common sense. Brazil could escape the debt prison. It would require political will, popular mobilization, and a willingness to confront the most powerful industry in the country. So far, that hasn't happened. The banks keep winning, the people keep paying, and every month, the interest compounds. 400%, compounding, forever. That's not a financial system. That's a wealth extraction machine wearing a suit and calling itself normal. And until Brazilians stop accepting it, it will never change. If this analysis opened your eyes to something you hadn't seen before, hit that subscribe button. Because the systems that shape our lives often hide in plain sight. And sometimes, the most important thing is simply to see them clearly. See you in the comments, and remember, economics isn't just about numbers, it's about power. Who has it, who doesn't, and who profits from the difference.